Yeah, thank you so much. I appreciate the opportunity to speak with folks today. I'm Kate Lynch Machado, Summit's Director of Client Development, and welcome to our webinar, The Impact of Investors on Local Housing Markets and the Potential Policy Implications. We really look forward to giving you an hour of an interesting conversation about what this subject is about for fair housing and how it connects to the Fair Housing Month. And we will get started. Before we get everything rolling for the webinar and have our experts talking to you about issues around investor single-family ownership, we wanted to give a few housekeeping tips. All audio and video have been turned off except for our moderator and panelists. We will be taking questions throughout the webinar. We just ask that you enter them in the chat and they will be responded to as appropriate. There's going to be 3 polls taken during the webinar, so plan on participating. This is also being recorded and will be sent out to all attendees after the webinar. You can listen to it, watch it at your leisure multiple times. We would love that. So if there are no questions, we can go ahead and get started. So today in our webinar, we are going to explore the potential impact of investors purchasing residential properties as second homes or investments. This practice has the potential to disproportionately affect lower income and higher minority communities in certain parts of the United States. Specifically, these transactions tend to crowd out residents, reducing their opportunities to necessary credit for purchasing homes. So in addition to current homebuyers, future homebuyers will be negatively impacted as investors typically flip these homes, resell them at much higher prices, or turn them into exclusively rental properties, further limiting the supply of purchasable homes in those neighborhoods. So to kick off this webinar, I've got a first poll question, and please see that pop up on your screen. It's I work in, and we would love to hear from you about what your environments are and where you work and what your role is. And if you could go ahead and respond to that, that would be very helpful. And Lisa will share that information with me as we go through that. Give you another second to click on the appropriate boxes or box. And you can always choose other if none of those fit for you. Okay. Lisa, are you good?
Yep, we're good. We've got 100%.
Ooh, look at us scoring great on this. So as we go through this, I also wanted to get a sense of what your backgrounds are as it relates to the subject matter. So another poll question will pop up, and this is going to be about, do you perform research or work in housing policy initiatives? And go ahead and click boxes that make the most sense for you. Click multiple, click one. And we would love to have that information from you so we know kind of what level to present at, although we're certainly going to give you as much information as you can to understand what the issues are, the acronyms, the buzzwords for this particular subject area. And one more second to click a box and then we'll keep moving. Thanks, Lisa. So now we're going to have a moment to meet our panelists, and I wanted to ask our first panelist, Corey, to give a bit of a background on who he is and why he cares about the subject and what he's going to talk about today.
Well, thanks, Kate, and good afternoon. As Kate mentioned, Corey West. I've been at Summit for 13 years, senior manager. My 2 roles in the firm right now is I lead our enforcement work. That includes improper payments, fraud, waste, and abuse, and of course, for today's topic, fair lending and affordable housing in those spaces. The other thing I do, which is very similar to that role, is I co-chair our diversity, equity, and inclusion program. So that allows us to work together to say, make sure we have the practices in place internally that we also require for the folks we're investigating. And today's focus, my area will mainly be around the early research we've done in this area of investors continuing to buy properties in single family areas, and also some of the early data we're starting to play with that's publicly available, of course, to start thinking about some research topics moving forward. But I'm happy to be here with everybody today. Josh, I'll turn it over to you.
Josh Goldberg. I lead the data science practice here at Summit Consulting with a special emphasis on mortgage finance. While Corey and my practices are somewhat distinct, we end up crossing paths quite frequently. Very similar interests. Prior to Summit, I worked in the banking industry and with government-sponsored entities. Within the banking industry, fair lending laws are fairly well defined. They tend And those, more recently, those, the focus has been on collateral valuation. And so you may have heard of appraisal bias. That's a topic that's been coming up very recently. So that's coming into the fair lending sphere. In addition to that, I work on modeling, and modeling sometimes intersects with the distressed housing market, which we're going to talk about today. So, banks for years and years have been focused on that front end modeling and deciding who to give credit to. But until the financial recession, the decision on how to dispose of properties was very much a manual process. And with all of the defaults and potential disposition, folks had to develop models to help them decide and maximize the recovery from those defaulted loans. And I have exposure reviewing those models, and Summit has also built a model called the Best Execution Model, which was enforced at HUD, sometimes known as valuation and disposition. So super excited to be talking on this topic today. There's a lot to cover.
Thanks, Corey. Thanks, Josh. I appreciate you giving us a bit of a background and kind of kicking off some of the ideas, just so we can kind of get everybody up to speed for the topics for today. We're going to touch on mainly 3 areas, and we're going to help folks understand more about the potential effect of investors purchasing residential properties. And then 2, highlight policies designed to reduce investor involvement in single-family housing. And 3, we're going to gain insight into how to analyze this impact using publicly available data by discussing what's been happening in recent years in some couple of large counties in the U.S. This is really going to be an application of using data to kind of talk about the issues that we're going to highlight at the beginning and the middle part of the webinar, and really give you a chance to see how we would start analyzing these issues so we can make some policy decisions or recommendations. Lastly, we're going to hit that last polling question for you. We're going to ask you our final polling question about what topics you're interested in hearing most about from us today. So feel free to check a box and kind of indicate those areas. We'll come back to that to make sure that we are strong and provide you the information that you need for the highlights areas that you care about. I do think we'll talk about everything here, but we just wanted to kind of see what people care about, the subject matters. Last second to hit the button, and then we're going to keep moving. Great, thank you. Thanks, Lisa. So to start off, I wanted to start with a question out to our panelists about a couple of areas. One is discussing the potential impact of investors. It's good to know who are considered investors in single-family housing and then housing markets. Can you describe, Josh, kind of who the investors are? And Corey, certainly you can jump in if there's areas that you want to touch in that point, and then we can go to give people a sense of where investors fit in the market.
Corey, you may have been more focused on this, but at a high level, it's we break them up into 2 categories for this topic: institutional and individual. But you may want to go into more detail, Corey.
Okay, yeah, thanks for that, Josh. So, these groups have similar habits. One, they are looking to purchase properties in which will not be their permanent residence. And then, the larger investors are looking more of a revenue stream. So but again, the main habit between those two, they will not be living in these dwellings. And this group includes mom and pop investors, that have 1 or 2 properties in their portfolio. It also includes nonprofit organizations. And the one, of course, you see a large increase are your larger institutional investors, including equity firms and hedge funds. But irrespective of the grouping, their main thing is that they will not live in the dwellings, but is also seen as a revenue generator for their practices, for their businesses.
Yeah, no, great. Thank you both for kind of giving us an overview of who those folks are. As I was prepping for this webinar, I noticed an article by Pew Research in July of 22 in their State Line publication, where they stated that investors bought nearly a quarter of U.S. single-family homes that sold last year, which would have been in 21. Again, I want to state that number, a quarter of the US single-family homes were purchased by investors. Corey, you study trends and look at data a lot around housing markets and kind of where things are going. Can you tell us about what happens to communities when the number of properties are sold to investors and it rises?
Yes, Kate. So, focusing in this space, the research has been around from my perspective, the positives. And, they fall into three buckets. The first bucket being easier transactions. Of course, those of us who have purchased or sold homes, we understand there is a lot of angst and anxiety and also, happiness at the same time. But thinking about a lot of times they're as-is purchases. Another thing about makes them easier is that funds are typically more available. And then lastly, which I think, if you've been through this route, closing day can always also bring a lot of, upset stomachs. But of course, in these cases, a lot of times fast closings are faster. That's one section. The other section is property maintenance. Think about it. If I am an investor, I want to make sure I have a return on my investment. So I must maintain my property. And then the last piece, which, can cause some issues, but is really a pro in areas that need this, is it can increase the supply of single family residences. Because again, if we're able to put homes back onto the market, that can allow folks to move into them. So again, easier transactions, property maintenance, and then the last piece is the increase in single family residents into some of these communities.
Yeah, I liked how you framed that, Corey. We're going to talk about the potential detrimental impacts of investor concentration, but clearly investors serve a place in the market. Just as with any asset, the greater participants you have in the market, the better the market execution. And you certainly, as a seller, want to get good market execution. There was recently a forum at HUD Policy Development and Research. Folks use the term PD&R for that group. But there was an event last December where they had a really robust conversation about this, and they did note some of the risks that we're going to talk about today. And in particular, there was a high concentration of purchases after the pandemic and in the Sun Belt, Miami and Phoenix in particular. On the one hand, when investors come in and they have the funds for large scale renovations, they take advantage of economies of scale. Sounds good to me. You're revitalizing a housing stock. But when the individual investors are potentially shut out from that market, that's where we have potential affordability issues and maybe equity issues. And so one of the things that was mentioned at that PD&R conference was, it was pondered, is there a way to level the playing field in terms of equity for individual investors so that to do renovation, so they're not at such a disadvantage for the economies of scale of the larger companies thinking about doing these. And in particular, one event we can point to where investors were definitely helpful is after the financial recession in 2010. There was a glut of vacant homes on the market, and as you alluded to, Corey, having vacant homes on the market is not good for anyone. That's dead weight loss, and so the investors came in and they served a useful purpose. But we'll get into some of the detrimental impacts and the mitigants, policy mitigants in a few moments here.
Yeah, no, great. Thank you, Josh. Thank you, Corey, for kind of highlighting some of the issues there. In the same Stateline article that Pew put out, they mentioned the CoreLogic data that talks about mega investors, mega investors being those with 1,000 or more homes. They bought 3% of the houses last year in 2022 compared with just 1% in the previous years. And, the bulk of these investors when normally they're purchased by smaller groups. So Josh, when we're looking at that housing market and the trends and the data on the economy, and everybody's talking about the economy, can you give us a sense of what macro trends are happening and spotlight for listeners around what to watch for the next 6 months to year out around some of these issues?
Yeah, I don't necessarily have any unique forecasts in terms of the market, but I can talk about what the baseline forecasts are and what that means for this topic. So interest rates have obviously gone up, and house prices have come down somewhat. So when you think about a surge in investor purchases, you might think that would happen when there was a clear signal of bottoming out of house prices. And I don't think there's a clear signal of bottoming out of house prices. House prices are still coming off a long period of sustained growth. And while there has been a little bit of retrenchment because of the rise in interest rates, nothing nearly as sharp as what we've seen in regional recessions or, certainly not the financial recession. That's why it's great for us to talk about is you want to put in some of the policy prescriptions before the economy takes a downturn and you need to have those policy prescriptions. So I think it's exactly the right time to be talking about these. As we think about policy prescriptions, investors obviously purchase houses all the time in a non-distressed market, and the way that you can potentially control that is very dispersed, as you can imagine. However, when in a distressed market, there's fewer agents in place. So you have the insuring agencies and the government-sponsored entities and the large banks, and so I wanted to talk a little bit about the stages of the distressed housing market, because I think this is going to be where some of the policy prescriptions come in. So loans become delinquent. There's a collection process to get folks current. If that doesn't work, you move to later stages of delinquency where you're potentially thinking about taking over the collateral, the property. When you get into those later stages of delinquency, there is something called a short sale. And so if the borrower is in financial trouble and they're no longer able to pay for their house, but they can't sell their house because they have negative equity, they can on their own go out and find a counterparty to purchase the house for them. And that has a benefit to the bank, potentially, that they can turn around and ask the bank if they would accept this short sale offer. That tends to be, earlier in the stage of distressed property management. A little bit later in the stage is what we would call a third-party sale, or claim without conveyance of title is what the term is at HUD. And here you're trying to dispose of the property, sometimes in an auction format. They used to term this auctioning off the property at the courthouse steps, because it was literally at the courthouse steps. These days it's not literally at the courthouse steps, but there's auctions for the property, and third parties have a chance to purchase these properties. And there's a reserve price that's set in this auction, and then if you don't get a good enough execution in these third party auction sales, you take the property into what's called real estate owned. The bank or the insuring agency takes the property into real estate owned. This is potentially a costly process, because banks and insuring agencies, they're mostly in the business of as credit intermediaries, determining who to give credit to and what the right price is. not in terms of managing property. So if all of a sudden they have a lot of property to manage, this is potentially a problem, and it's potentially costly to market the property and maintain the property. And so generally speaking, you want to avoid this because this is one of the costlier disposition options. And that's where some of the modeling that I was talking about comes into place. Is you have to figure out what short sales you should accept and how much you want to encourage short sales. Maybe have a target percentage for the number of short sales. Same thing with third party sales. You'll want to think about a reserve price. And finally, when you take the property into real estate owned, you need to think about sort of the proper listing price. And so this backdrop, I think, is important to know as we get into the policy prescriptions, because these are going to be the points where policymakers can insert themselves.
Yeah, Josh, thank you. I was just thinking that because, not being an expert in housing and not being an expert in how this process works, as a regular buyer, I'm not aware of these things as they happen, right? And so institutional investors will have a leg up because this is what they're watching for and what they're looking for. And so it is interesting to talk about it from a policy implication. And so kind of moving to that discussion, we've talked a bit about the benefits of institutional investors in jumping into the market, certainly after the financial crisis, and then of course after and during the pandemic. It'd be interesting to talk now about what maybe some of the detrimental impacts might be with investor participation and just give folks a sense about what that, we just talked about some policy implications, but what does that look like?
Yeah, you started off the webinar, Kate, using the term overcrowding. And I do think that crowding out rather, and I do think that is the right term for it. I guess I would put it into two buckets. One is affordability and one is home ownership. From an affordability standpoint, if investors come in and they purchase a lot of the housing stock and they renovate it, they may turn these into luxury homes that could have an effect on the affordability in communities. And second, there may be people who've been patiently waiting in the communities as renters, and they want to become home buyers. And if there's aggressive bidding from investors, that may be disappointing to them and have an impact on home ownership rates. And so just to highlight what's going on with home ownership rates these days, because I think it's super important. And HUD in their equity action plan, they note this, and they've come up with a lot of great early action plans to address it. But the home ownership rates are relatively high right now. I think somewhere around 69%. But the gap between white and non-white is the highest it's been in 50 years. So for the white population, it's 73.1, around 41% for the Black population, and around 47% for the Hispanic population. So the effect that I was talking about before is if some of these investor purchases happen in lower income neighborhoods, in minority dense neighborhoods, and it could have the potential effect of exacerbating this gap in the home ownership rate. And certain studies have shown that owning a house is helpful in terms of building your net worth over time. So we want equitable access to that sort of savings vehicle.
Yeah, it's a good thing to think about. I mean, where people and the institutional investors are making their investments, may bump up against the ability for folks to be able to buy houses in their neighborhood. And it's a good thing to consider as the part of the policy perspectives. And, that we've been talking a lot about the bigger picture, the federal government and other folks that have a more macro view to this issue. Can you give us a sense about what some of the folks are doing in agencies or local housing authorities to kind of curtail investors in their properties?
So I'm probably less close to the state and local areas, Kate, but I know that HOAs are sometimes monitoring the amount of investor properties in their communities. And state and local municipalities could put into place things like waiting lists, which waiting periods, which I'll talk about a little bit more in a second. So that's some of the things that are done at the state and local level. Thinking about the government-sponsored entities, Fannie Mae and Freddie Mac, and the federal agencies. I'm thinking primarily HUD, but also USDA, Rural Housing Service. They have policies that they can put in place. Starting with the GSEs, the multifamily group at Freddie Mac, and I believe that probably something similar at Fannie Mae, but I'll talk about the one at Freddie Mac. The put into place an incentive, a financing incentive, to try to make it sort of like break even. If an investor wanted to come in and renovate a property and turn it into a luxury home, well, they would get a certain return on their investment. But if they agreed to keep the home affordable, they could get a better financing option. That better financing option might make it a coin flip in terms of whether or not they keep it affordable or turn it into a luxury apartment. So I thought that was a very clever market-based solution. There is a playbook that HUD has rolled out, which I think is very useful. But before I talk about the playbook specifically, maybe it's useful to talk a little bit about the objectives. Is you don't want to give up too much market execution, so you should probably define beforehand what decrease in market execution is it worth to me to make sure that it stays owner occupied. And so I'll just throw out a number here, but maybe you would take out, you would be okay with 3 to 7%, less in proceeds, as long as you knew that it was going to stay owner occupied. But this is data that you want to measure and collect. It relates directly to policies that HUD has in place right now. So they have an exclusive listing period for real estate owned, and they've the various mortgagee letters have actually extended that exclusive listing period from 15 to 30 days. So I think that's a clear winner in terms of a policy prescription. The same is being done with claims without conveyance of title, putting in that exclusive listing period to try to make sure that it stays owner occupied. There's also the note sales of vacant properties, and so there are set-asides for mission-driven nonprofits that are going to rehabilitate the homes, keep them affordable, and have them be owner occupied. This is also a promising idea. Again, though, I mean, Corey and I are data-oriented folks. We want to measure outcomes. So if you're enlisting these nonprofits, what do you expect in terms of market execution? What do you expect in terms of what are your goals in terms of keeping the overall housing stock owner occupied? Is that working? And so we're a data first. We always have a data first kind of approach.
Yeah, thanks for that. I was thinking about that as well, as you kind of are suggesting different ideas that HUD has put into place and they may consider putting into place. A lot of that is something that you can set up a system to be, thoughtful about, assessments and early evaluation or kind of models to see if these ideas potentially could work, and then pilot perhaps in other places. So, I completely agree. And it's, Corey, I was still going to come to looking at the data. And before I do that, I want to remind folks on the call, and watching the webinar, that you're welcome to submit questions and we'll take a look at that. And perhaps the area that Cora is going to highlight around the counties that I'm going to give you a kind of a sample of what the data is, as far as it's an analysis. We're not trying to prove things here. We're just really trying to think about, how you would take data to look at the issues and start to kind of get a sense of what the problems and the benefits, and kind of how you would start to adapt to the market around investors in single family homes. You can submit questions in the chat and we can certainly get to those, and perhaps after Corey presents, you'll have more questions to ask. So Corey, I don't know if now's a good time, but if you want to jump in and talk about counties, that would be great.
Yeah, so now is a good time, but I want to echo something, but I'll make it even amplified. What we're about to show will not put us in contention for our Data Fest competition this weekend. These are really early data habits that we're working around. So I just want to make sure I'm clear. We're not, to Kate's point, we're not trying to prove anything, but again, we are starting the process now of really thinking about how to analyze the data. And the data we use for this is publicly available. It's a data set that, Summit has used for independent research and for our clients. It's HMDA data, Home Mortgage Disclosure Act data. And it requires lenders that originate at least 200 or more open-ended lines of credit. They must provide the data to CFPB, right? And it gives, the industry a chance to, as you can imagine, analyze changing in lending activities throughout the entire country. Again, for lenders that are originating at least 200 loans on an annual basis. The two counties we're looking at here are, one is Duval County, which is in Jacksonville, Florida. The other one is Queens County in New York. The reason for choosing Jacksonville or Duval County is because many of you know, that's where I grew up. So there's a little piece there. Queens County is similar to Jacksonville in terms that it is a racially and ethnically diverse county. So it kind of gives us a pretty good way to just look and see how some of these areas are impacting different sets of borrowers. And as a part of that, the data are, include 2018 through 2021 activity years. Again, of course, as always, this data, folks, we would love to have as many years back, but just trying to start this process slow to make sure we're doing something that's attainable is key. And then the last main piece I want to talk about in terms of the data is that we bifurcated the data into two buckets. One being, we'll call them not majority census tracts, and I'll tell you what that is, and then some that are majority census tracts. The majority census tracts are the census tracts that have at least 50% of the residents are minority, as defined in the HMDA data. HMDA also uses, as you can imagine, Census Bureau data as well. So we're using that as our line in the sand, which is consistent with what we've done in other fair lending analytics. But again, the goal here is to start that process. I'm going to share my screen and let me know if you can see this. I am just 3 graphs, again, just to kind of start the conversation. So you may ask the question, Corey, what am I looking at here? So you're looking at 2 things on one graph, and I'll walk you through it. So the first question we're answering is, what is the percentage of the census tracts in our data set are defined as majority minority? I believe we have roughly 319 census tracts in this data set, but again, we're asking ourselves the question, what percentage of those census tracts in the data set are considered majority minority? That's the orange bar. And in these data, we have basically 1 out of every 2 of the census tracts are defined as majority minority. But at the same time, since we're talking about, investor involvement, we also want to ask ourselves a question. If we look at the data set from a perspective of the reduction in ownership rates over this 4-year window, what percentage of the census tracts are in the top 20th percentile in reduction will also be defined as majority minority? That's the green bar. So, and that number is roughly 2/3. So there is, some would say, an overrepresentation because majority minority communities here make up 1 out of every 2 in the census tract that we have, but they make up 2/3 of those that currently have experienced a larger reduction in ownership in those census tracts. Another space we're looking at is changes in income. right? One of the data pieces in HMDA is median income of the borrower. And what we see here is, a slight uptick in both. In the not majority minority, roughly 4%, and in the majority minority, roughly 5%. And to do this, what we've done, we've only included those census tracts that have experienced a reduction in ownership over that 4-year window. Again, there's not much to tell about. You're starting to see somewhat of an uptick in the median income for the borrowers in these census tracts. The other piece that was of interest to us, think about affordability, is property values, right? And or to Josh's point, also the accrual of wealth. So we're asking ourselves the question again, of the census tracts that have experienced a reduction in ownership rates between those 4 years, what's been the median change, percentage change in the property values? As you can see in the not majority minority, is roughly 21%. And then for the majority minority, it's roughly 18%. So, you can start to get a sense of where we're heading with this analysis, but, the goal right now is just kind of start walking through and thinking about how can we analyze these data as they are publicly available. So we see ownership rate changes. We also see very modest income rate changes. And lastly, we start to see also changes in property value, median property values over that same four-year window.
Corey, this is great. Thank you so much for sharing this. It really does prompt the questions, makes me, of course, I'm sure others just wonder what comes next. How do you take data like this just to start to prompt policy ideas or, different communities to examine, and how does that work? And so it's a great snapshot of how we would start that conversation. And I appreciate that. We are put this webinar together because it's Fair Housing Month, and we are very big in fair housing, and we wanted to make sure to kind of highlight some of the issues. And Josh, I'll start with you. How do you see investor-owned properties and single-family properties? How does it relate to fair housing?
Yes, it's interesting.
Sorry, Josh, I just want to step
Yes.
in really quick. We did have a question that came through. What do you see as the next steps in Summit's effort to continue researching this topic?
So I guess I'll go first and then Josh chime in. So, and from a data perspective, again, this is very early, but it kind of falls into 3 areas. One area is continue looking at additional borrower characteristics. Because HMDA provides you LTV and DTI data to start to see, does the risk profile, or do we see a change in the risk profile of the borrowers in these communities? And that is the other piece is, the census tract changes. Josh was talking about home ownership rates. Do we start to see the demographics changing as investors become more involved, more engaged in these certain markets? Then the last piece, which is always kind of where, as a firm, we'd like to end up are there some correlations? So start asking ourselves the question, is there a level of involvement in communities, and how does that impact those communities from an approval status, right? From a borrower characteristic. So again, thinking about the summary stats on the front end, but then moving to see, is there somewhat of an optimal mix of investor involvement in some of these communities to make sure we keep them as they have been today? Well, hopefully that answers the person's questions. Thank you for that question.
It does. And thank you, Corey. We do have one more before we move on. I just want to have you respond to, and then we'll continue on. And this question is, so median incomes for majority minority census tracts went up, but median property values did not move much. Did I interpret that correctly? And if so, why?
So let's go back to that. So median property values, let me reshare my screen. Now, of course, I'm in no position to tell you why right now, but I can tell you what's going on. I'm not going to venture off but I can show you as a reminder. Can everybody see my screen again?
We can.
So property values have experienced an uptick in 21%, and median, that's a not majority, is 21%, and it is 18% in majority minority, right? So let's ask ourselves a question. What does this mean? This means purchasing homes is becoming more expensive in all these communities, irrespective of not majority minority. That's the first piece. When we go to the income graph, you ask ourselves the question, in these communities that have experienced a reduction in ownership rates, what's been the change in the purchasing power? As you see, the purchasing power in the not majority minority is 4%, and the purchasing power in the majority minority has changed by roughly by 5%. So again, we're not here to, I guess, give an answer as to why, but that is something we will be investigating as to see if there's underlying trends that we can detect.
Thanks,
Thank
Corey.
you, Corey.
Thanks again for the question.
I just wanted to go back to the next steps question is I liked what you were saying about optimal mix, Corey, and there may be an opportunity for a consortium or a similar to PAVE for appraisal bias, getting the federal agencies, the GSEs, state and local together and really sort of thinking about objectives. I'm really focused on setting objectives and measuring what performance outcomes around this subject. So again, what we've gone through today has shown that investor participation is neither good or bad on the surface of it, but it could have potential detrimental effects. So we want to sort of define those outcomes, define and measure those outcomes, and then review whether or not our policy prescriptions are helping.
No, that's great. And that leads actually to how this relates to fair housing. As the subjects that we've kind of been tossing out today don't have the word fair housing in them, but I wanted to kind of just get a sense from you, Josh, on how this webinar came about and why that was in Fair Housing Month.
But it's funny that you should ask that, because Corey and I, when we originally picked this topic, we were scratching our heads and saying, did we pick a fair housing topic? Is this more of a affordable housing topic? But I think we've sort of answered the question throughout the exploration of it. Is that affordable housing tends to have positive knock-on effects, not always, but tends to have positive knock-on effects on fair housing and vice versa. So a lot of the policies, I don't know why this is such a light bulb moment for me, but that they can accomplish both at the same time.
Okay, one more thing along those lines. Thinking about one of the policies that Josh mentioned earlier is, the vetting process of home buyers, right, into certain communities. Of course, kind of where Josh was headed is that you think about, it makes sense on paper to say, if we want to ensure that our community remains, 85 to 90% owner occupied, we may implement a policy that says, let's vet every home buyer. But the fear of that is that it could easily slide into vetting every home buyer to make sure they look and behave and believe the same things we believe in as a community, right? So, from the outset, it can start off as we want to make sure we stay owner occupied at a certain level, but as in the housing market that we've seen, it can easily lead itself to a space where certain borrowers, certain potential home buyers are being discriminated against by the homeowner, the HOAs, can't say that today, with respect to these sliding scales. That's what we'll be mindful as we kind of do this research to see, do we start to find pockets of resistance for change, not just for investors, but also just certain borrowers moving into certain communities.
Yeah, no, that's a great point. And, next steps we've highlighted are not just our job, right? We're certainly begin focusing on these issues, but we're certainly willing to have conversations with our clients and our partners and, communities around some of these issues, and certainly engage on them and help think about what the data may look like going forward. Now is a good time if you have a question. We are happy to answer that. The opportunity for questions and answers doesn't end at the end of the webinar. We are happy to take questions through this chat. This chat is going to be available to folks. You can also submit a question to me at info@summit llc.us. That's our general box for sending information, and we're happy to respond, today, or when you're wandering around your neighborhood and walking your dog and a question comes up, certainly drop it to us. And at this time, I like to thank our panelists, Josh and Corey, for sharing their insights on the topic around investor properties. And, we also want to thank you all for giving up your hour to kind of spend time thinking about these issues with us and talking about them. This is an issue that is kind of bubbling, and, HUD is focusing on it, and others are spending some time trying to think about what policy implications there are around, the different issues and what the data looks like in communities. So we're happy to have this conversation today. And again, thank you to you all. Thank you to Josh and Corey. We look forward to the next webinar.
Yeah, thank you, Kate.
Yeah, thank you, Kate.
Awesome. Enjoy your day, folks.